Welcome to The Explainer. So today, that's Thursday, January 29th, 2026, the global markets sent some really complex and, frankly, contradictory signals. We're talking deep splits between the old and new economies, between East and West, and even a fascinating clash between a central bank and its own government. Let's break it all down.
All right, let's get right to the heart of it, the real puzzle of the day. How is it that U.S. tech stocks took a tumble while the broader economy actually showed signs of strength? On the surface, that just doesn't add up. So what's really going on under the hood?
Okay, to really get a grip on today's market action, you got to zoom out and look at the bigger picture. And right now, that picture is dominated by a pretty tense standoff between the Federal Reserve and a whole lot of political pressure. Seriously, this context is absolutely crucial for everything that follows.
So what happened was, just yesterday, the Fed decided to, hit the pause button. Remember those rate cuts we saw back in late 2025? Well, for now, they're holding steady. The official line is that the economy is chugging along at a solid pace, and they kind of want to just wait and see how their previous moves are working before they do anything else.
But here's where it gets interesting. Things aren't nearly as unified as they look on the surface. We're seeing real friction inside the Fed. So while you have Chair Powell talking about a resilient economy, two of the governors, Miron and Waller, actually dissented. They wanted another rate cut right now. And that split, it's a perfect reflection of this bigger battle between the Fed's cautious approach and the political world screaming for more action.
And that political pressure? It just went from subtle to, not subtle at all. The Department of Justice actually served subpoenas. Powell's response was incredibly direct. He called it a pretext to punish the Fed. Now you have to understand, this isn't just some political theater. This is a direct challenge to the Fed's independence, and you can bet the markets are watching this very, very closely. So with that whole political drama as the backdrop, let's see how it all played out in the markets themselves. And both in the US and over in Europe, the story of the day wasn't just up or down. It was all about division, a real split personality. And you can see that split perfectly right here in the US. Look at that. The Dow Jones, packed with all those big industrial and financial names, it actually managed to creep up a little. But the Nasdaq, the home of big tech, dropped by more than 0.5%. That, my friends, is what we call a classic rotation. Money is literally flowing out of high-growth tech and into those more traditional, old economy kind of stocks. So you've got to be asking, why the big drop in tech? Well, one really interesting theory is something called the over-optimization trap. Think of it like this. Investors had basically priced in a perfect, flawless future for AI earnings. The expectations were just sky high. So when a giant like Microsoft comes out with a slightly weaker outlook, bam, it's like a pin popping a balloon. That crazy optimism flips to panic in a heartbeat, and everyone rushes for the exits. And if you think that was a split, just look at what happened across the Atlantic. The story in Europe was even more dramatic. Check this out. Germany's main index, the DAX, just plummeted over 2%. Meanwhile, the UK's FTSE 100, it actually finished the day up, a total night-and-day situation.
And why did the German market get hit so hard? It really boils down to one single shocking number, 16%. That's how much the software giant SAP plunged after it missed earnings. One company's bad day was enough to drag the entire German market down with it. Just incredible.
Okay, so while the West was dealing with all this division and uncertainty, the story over in Asia was the complete opposite. In fact, what happened in South Korea today was nothing short of historic. The contrast is just wow. And here is the number of the day, maybe the number of the year so far. That's the closing price for South Korea's KOSPI index. It didn't just break its all-time record, it absolutely shattered it. This is the first time ever it has closed above the 5,000 mark. Just a massive, massive milestone. So, why the huge surge? Sure, you had record-breaking earnings from giants like Samsung, and that definitely helped fuel the fire. But the real story, the big one, is about something deeper: institutional reform. The South Korean government is pledging to improve things for investors, to make real changes, and that's sending a powerful signal to the world that the infamous Korea discount, that valuation gap that's existed for years because of governance worries, it might finally be going away.
Okay, so that's what happened today, a wild ride. But what does it all mean for the road ahead? Let's switch gears from analysis to forecasting and take a look at what a quantitative model is predicting for the next month.
And starting with Korea, the model suggests this is just the beginning.
All that momentum from the reform news, it's expected to keep going. The forecast is for all that positive energy and new money to push the KOSPI even higher, with a near-term target of 5,500.
Now let's jump back to the U.S. Remember that rotation we talked about, away from tech and into the old economy stocks? Well, the model expects that to continue. And that trend is what's forecast to keep propping up the Dow Jones, potentially pushing it toward the 51,000 mark.
So this table kind of puts it all together for the month ahead. And here's the bottom line. The outlook is really bullish for Korea and for the broader U.S. market. But, and this is a big but, the forecast is for a ton of volatility in tech and a much flatter, kind of sluggish recovery for Germany after that big shock it took today.
All right, we've covered the what and the why. Now let's get into the so what. Let's try to distill all this down into a strategic playbook. How would a professional quant look at all this and start thinking about their next move? And I need to be super clear about this next part. What we're about to go through is a case study. It's an exercise in strategic thinking based on the data. We're just exploring a framework, okay? This is absolutely not investment advice in any way, shape, or form.
So the strategic thinking boils down to a three-part framework. First up, institutional convergence. The basic idea is to focus on the shrinking valuation gap between a place like Korea, where things are getting better institutionally, and the US, where political risk is, well, it's getting higher. Second, AI localization hedging. This is all about finding companies like Baidu, for example, that are building their own AI worlds, kind of shielded from all the US-China drama. And third, volatility and cycle harvesting. Basically, using the quiet times to manage risk while also putting money into commodities that line up with bigger, long-term cycles.
If you take one thing away from today's analysis, it should be this. The rules of the game might be changing. What we saw today could be a real transition point, where the market's focus is shifting away from just growth potential and moving toward things like institutional trust and, actual real earnings. And that leaves us with one last big question to chew on. For the past couple of years, right, the big boogeyman in the market has been inflation. But now that the central banks seem to have a handle on it, do today's events signal a major shift? Is the biggest risk factor for the markets in 2026 no longer inflation, but politics? Definitely something to think about.